Hello, and welcome to Money Mystery No More. Let's talk about money, plus money benefits of risk management. As we discuss various concepts and the money benefits of risk management, prepare to get the most out of this video by honing in on how those concepts apply to your situation and how your own money might benefit directly with risk management by keeping it simple. It's awesome, and remember, hit that subscribe button to keep getting the latest and greatest information. Okay, let's remove the mystery. Money is such a big topic and a big part of our everyday lives. Let's peek at some history involving the famous buck and the evolution. While money certainly predates the Revolutionary War in the United States, that was sort of a starting point of paper currency. It was in 1775 that continental currency, as it was known, was issued and backed with potential tax revenues to finance the war. However, the paper money didn't gain solid backing and got counterfeited easily. That led to devaluation and some slang. Yep, people would say something was not worth a continental. Nearly 2 decades later, the first American coins were made by the new U.S. Philadelphia Mint after the federal monetary system was established. Then in 1861, again due to war, paper money called demand notes were issued to finance the Civil War. They were non-interest-bearing treasury notes, which were, shortly after, replaced by the U.S. notes known as greenbacks. Then history repeated itself once more with the problem of counterfeiting. So in 1865, the U.S. Department of the Treasury established the United States Secret Service. Their job was to control the rampant counterfeiting, believed to run near a third of all U.S. circulating currency. Nearly 50 years afterwards, the Federal Reserve System was created in 1913. That system issued Federal Reserve notes, and they were also tasked to regulate money flow, credit for economic stability and growth, and act as the nation's central bank. Then we got consistent portraits on the front of the bills, along with emblems and monuments on the back in 1929, with the introduction of standardized design currency. Then the great inscription, "In God We Trust," was added to paper currency in 1957. Counterfeiting continued to rear its ugly head, so from 1990 through 2000, a security thread and microprinting of our bills was introduced. The denominations of $100, $50, and $20 bills got the security features in 1990. Then our $5 and $10 bills got a makeover by the year 2000, again in the spirit of combating counterfeiting. That's when we got the really large Abraham Lincoln and Alexander Hamilton pictures. Several other high-tech measures were added, including the use of ultraviolet light and tiny printing to detect fake money. Money has a great history, and it continues to evolve, as do counterfeiting issues. Yet today in our daily lives, there are many various concepts and ideas associated with money that we must be prepared to handle. Important concepts like interest, financial planning, tax strategies, needs versus wants, cash flow, retirement, and to deal with it all, risk management, so your money behavior is rewarded along your journey. First, let's understand what risk management is. In the context of your money, we can pull from the business world and relate it to your personal finances. A business protects its economic value by mitigating exposure to risk as it relates to their money and financial viability with operations, credit, and the market or industry it is in. So both you and business share that, and you both want risk management strategies. For your personal money benefits, these strategies are designed to help manage various financial risk incidents by having a set of actions or plans to mitigate them. These risk incidents are typically things that may occur which cause negative or unwanted stress to your financial situation. And there are many risk management strategies, but the most common 4 normally include: 1. Risk avoidance is a strategy, a deliberate tactic to avoid costly consequences of threats or hazards that can cause damage to your personal financial situation. Identify as many of those threats as possible, determine the likelihood and potential damage of each, then take steps to avoid and deflect those threats. Consider having secure passwords or login credentials. Carry less cash while using banks more often. Then there's number 2, risk reduction, a strategy to minimize the actual damage to your personal financial situation by reducing associated risk factors. You may have to face natural disasters or cyber attacks, but consider diversification, time compounding, and even dollar cost averaging. Also consider smoothing ebbs and flows to your 401k or Roth contributions by making continuous contributions. The third is risk transfer, literally transferring your financial risk of damages to another party who has agreed to take on some specified potential losses. Your home or vehicle insurance is a prime example. Without insurance, you'd be in real trouble if something catastrophic financially were to happen. For a premium, your insurance policy protects you. And finally, the fourth, risk retention, a strategy in which you choose to not transfer risk and assume all risk to pay for all losses. One option is to have a very high deductible in exchange for low premiums. Another option is you have significant funds to self-insure if you feel it's less expensive to handle a claim yourself if it were to happen. With those 4 options of risk management, it will be good to keep them in mind and consider how each may be applied as we walk through some money concepts. Starting with interest. Know that interest applies to both loans or to investments. One person pays interest while another earns interest. Typically, the person earning interest is the lender, while the person paying interest is the borrower. Even you can be either the lender or the borrower in a given situation. Simple interest is basically a fee that borrowers pay to a lender for a loan over the life of that loan. The fee is typically expressed as an interest rate, and the life of the loan is the term or length. The fee then is an interest charge, calculated using the principal amount only. That principal amount is the amount you start with. The interest rate is applied to that principal amount each time to calculate the interest fee. Simple interest just multiplies the interest rate by the principal amount and factors the term of the loan. Then there's compound interest. It's the amount earned or charged on the original principal amount and subsequently the balance amount, which is the new running amount at the designated time of calculation. Whatever that amount is, the related interest rate is calculated on the balance to determine the interest fee. The interest fee is then added onto the balance, thus it is compounded. So both simple interest and compound interest are basically a fee, also known as interest, that borrowers pay to a lender. The borrower and lender can vary. You can be the borrower that uses someone's money or assets, but you can also be the lender and loan your money to another party so they become the borrower. Realizing the money benefit of risk management with interest depends on how the interest rate, works for you or how it works against you as the lender or the borrower. Financial planning is another money concept with risk management benefits. Regardless of how you obtain money or spend it, financial planning involves you reviewing your long-term and short-term financial goals to understand how your current financial situation plays into the success of those goals. You literally start some basic strategies immediately to begin making those goals a reality. A deep dive evaluation is done of your current financial situation. It will involve transparency of your income and every single debt and expense in your life. Then you dig into your current goals, plus 5, 10 years out, and yes, even your retirement. This will further involve revisiting your needs versus wants, so there is alignment, if necessary. Being clear on this is critical as you figure out what's important. Needs are things like groceries, rent, mortgages, basic utilities, transportation, childcare, insurance, and that little evil thing known as a minimum payment. Wants are things like, well, stuff that you want. Being honest involves asking easy questions like, is this important to keep my life together, or is it more of a convenience for me? If you say convenience, or if you can get by without it, it's a want. Realizing the benefits of risk management with financial planning depends on how you want your future to be and what you can actively take charge of to make that happen. Your outcome will depend on what level of discipline you put forth. Financial planning is fairly involved, whereas another money concept, cash flow, is not as complicated really, other than the numerous definitions and meanings. If you sift through all of it though, cash flow is easily understood as ins and outs, or simply revenue inflow versus expenses outflow. It's knowing what money is moving in and out of accounts, essentially because the outcome can mean several things, not always good, but not always bad. Negative cash flow is pretty much what it sounds like. In the business world, when spending more money than receiving, it's negative cash flow. The resulting negative amount is a minus and is the business net cash flow. But just because it's negative does not necessarily mean it's a bad thing. It depends on the situation. Think of this. Maybe there are big investments for future growth. Well, that means a company is investing into capital expenditures, and the money left over is free cash flow. That investment is being done to create future shareholder value, and that is viewed as a good thing. On the other spectrum is positive cash flow. Again, it's pretty much what it sounds like. When a business receives and brings in more money than they spend, it's positive cash flow. The resulting positive amount is a plus and is the business net cash flow. Similarly, your personal finances may result in a net cash flow that is due to a negative cash flow or a positive cash flow, and that's okay. It depends on the situation. An example may involve actions with your future financial health and independence. Realizing the money benefit of risk management with cash flow depends on how you view debt, growth, and even financial stability as your finances are related to cash flow. This conversation barely scratches the surface about money concepts. You should work through them, understand them, relate each to your own situation. Then you've got taxes, college funds, debt consolidation, retirement, tax strategies, and even estate planning. More money benefits of risk management to consider. Sure, a lot. And because your situation is unique, at some point, you may want expert or professional help. Hire a CFA, a Certified Financial Advisor, or CFP, Certified Financial Planner, because they are good at this stuff. They help people develop financial plans which usually involve a lot of these concepts. Our other video, More Money Benefits of Risk Management, will cover some of the CFA, CFP info along with more money concepts. For now though, you've received a decent kickstart to get you moving with the money benefits of risk management by keeping it simple. Remember, hit that subscribe button and turn on notifications so you keep getting the latest and greatest information from Money Mystery No More. I'll see you in the next video.